Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about JD.com Inc. latest report. JD.com Inc. offers a wide range of businesses and services through its three main segments: JD Retail, JD Logistics, and New Businesses. The company provides various products such as home appliances, mobile handsets, computers, furniture, apparel, cosmetics, pet products, and more. In addition to product sales, JD.com also offers online marketplace services for third-party merchants, marketing services, and omnichannel solutions to customers and offline retailers. The company's logistics segment provides installation and maintenance services, asset management services, and integrated service platforms. JD.com's New Businesses segment includes the development of technology-driven supply chain solutions, leasing of storage facilities, and related management services. The company also engages in online retail business, offers online healthcare services, and provides virtual goods such as online travel agency services and prepaid phone cards. Furthermore, JD.com owns and manages its logistics facilities and other real estate properties to support third parties. This comprehensive range of businesses and services enables the company to provide a one-stop solution for customers' needs in China and Europe. JD.com Inc. market capitalization of $323 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that JD.com Inc. holds a significant advantage in their industry. JD.com Inc. trades at a higher price-to-earnings ratio of 16 times and a higher price-to-book ratio of 1.25 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 58% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 3.31%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for JD.com can be attributed to several key factors. Firstly, the company has seen an increase in annual active customers and expanding user base, leading to higher shopping frequency. Additionally, deepening synergies across its business ecosystem have contributed to revenue growth. The company's retail segment, JD Retail, has made steady progress in general merchandise categories and high-margin businesses. Furthermore, strategic partnerships with leading home appliance manufacturers have also driven revenue growth. JD.com's expansion into new businesses such as food delivery, online retail, and logistics has also been a significant driver of revenue growth. The company's net service revenues increased by 20.6%, while JD Logistics revenue growth reached 29%. The company's strategic investment in new business initiatives has also contributed to its revenue growth. On the other hand, the primary drivers of revenue decline for JD.com include fines imposed by regulatory bodies and internal revenue declines due to reclassification of on-demand delivery services. A fine of RMB 0.6 billion was imposed by the State Administration for Market Regulation, SAMR, leading to a decrease in income from operations and non-GAAP income from operations. The net income of the company experienced a significant decline, decreasing by 53.2% from RMB 10.9 billion to RMB 5.1 billion. This trend was consistent across different currency conversions, with a decrease of 48% from $11,279 million to $5,830 million and 51.4% from $11,664 million to $5,628 million. The non-GAAP net income also saw a decline, decreasing by 42.2% from RMB 12.8 billion to RMB 7.4 billion. The profit margins of the company suffered as well. The operating margin decreased by 66.9% from 3.5% to 1.2%, while the non-GAAP operating margin dropped by 54.4% from 3.9% to 1.8%. The net margin also declined, decreasing by 55.6% from 3.6% to 1.6%. These significant declines in profit margins and net income indicate a substantial deterioration in the company's financial performance. The company is experiencing a significant improvement in its financial performance. One key indicator of this growth is the generation of positive operating cash flow. According to the latest figures, the company's net cash provided by operating activities reached RMB 555 million, approximately $80 million, in KON 2026. This positive trend is consistent with the company's overall financial health. The data from page 21 confirms that the company's operating cash flow for the 3 months ended March 31, 2026 was indeed positive, with a net cash provided by operating activities of RMB 555 million. This suggests that the company is effectively managing its operations and generating sufficient cash to meet its financial obligations. The generation of positive operating cash flow is a crucial milestone for any business, as it indicates that the company is able to cover its expenses and invest in growth initiatives without relying on external funding. With this achievement, the company is well positioned to continue its upward trajectory and achieve long-term success. The company's debt level has undergone significant changes over the past year. Notably, interest expenses have risen substantially, increasing by $86 million or 14.3% from 2025 to 2026. This increase is a clear indication that the company is shouldering more financial burdens in terms of interest payments. Furthermore, an examination of the company's debt structure reveals notable changes. Short-term debts have increased by 260 million RMB, while long-term debts have seen a substantial rise of 487 million RMB. However, it is worth noting that unsecured senior notes have decreased in both current and non-current liabilities, suggesting some level of debt restructuring or refinancing may be underway. Overall, the company's debt level has increased significantly, with interest expenses also on the rise. This trend suggests a heightened financial risk for the company, which will need to be carefully managed to ensure long-term sustainability. JD.com's management is optimistic about its future prospects, citing a strong potential for business development. To achieve this, they are focused on 3 key areas: attracting new customers, increasing revenue from repeat customers, and expanding market acceptance of their products and services. The company is confident in the growth of the Chinese e-commerce market, which it believes will drive its own expansion. This confidence stems from a well-thought-out strategy that addresses various aspects of the business, positioning JD.com for long-term success. That concludes the financial summary for JD.com Inc. Feel free to comment below, and I will be happy to answer them when possible.